We're often asked, what type of mortgage is the best one for me? What are the different types of mortgages, and what do I need to consider when choosing a mortgage provider? Whether you're taking the first steps on the property ladder, moving home, purchasing a buy-to-let property or building your dream house, there are a number of things to consider when choosing a mortgage. In this video, I'm going to explain the different mortgage options available and some things to consider when deciding on a mortgage product. Having worked in the North East region for 20 years, helping people find the best mortgage for their needs, I'm confident that this information will help you choose the best mortgage for you with as little stress as possible. Nowadays, are capital interest repayment loans. This means that you pay back the amount borrowed plus interest over that period, and each month the amount you owe decreases. A very small number of people may take out an interest-only loan. Their monthly repayments only pay the interest on the loan, which means that at the end of the term, they still have to pay back the amount borrowed. And this is usually a very big sum. So if we return to the capital interest repayment mortgage, there are a number of options available. You can choose to fix your interest rate, which means you know exactly what your monthly payments will be for a fixed period of time, usually 2, 3 or 5 years. These can be really helpful for budgeting and can safeguard against rising interest rates, although if interest rates decrease, you could be paying more per month than the market rate. Tracker rates do what they say. They follow the Bank of England base rate and are usually a certain number of percentage points above the base rate, for example, 2% above the base rate. These are more volatile as they can change regularly and can be a good option when interest rates are decreasing, as you would benefit from the rate reductions. Standard variable rate, or SVR, is the default rate that your mortgage will revert to if you do not review it upon the expiry of your fixed, tracker or discounted rate. The rate is variable and will be set by the lender themselves. So, it may look like the fixed rate is the best option in most cases. This is where consulting an independent mortgage advisor may be helpful. Not all fixed rates are the same, and we can scour the market to look at the small print. Most fixed rate terms will include penalties if you end the mortgage before the fixed term. For example, you decide to move house. So it's important to understand what these are. Also, some mortgage products have an arrangement fee, and these will generally offer a lower rate than the equivalent deal with no fee. Fees can vary, and for example, what looks like a low fixed rate may have high arrangement fees, making a slightly higher fixed rate actually cheaper overall. It's also important to consider the future if you are fixing, as this rate will be with you for the next few years, so it's important to make sure that it matches your plans. Is this to be your forever home, or do you plan to move again in the near future? Everyone's personal circumstances are different, so if you're thinking about changing your mortgage or getting on the property ladder, start a conversation with one of our knowledgeable and friendly independent mortgage advisors to help find the most suitable option for you. Fill out the contact form on our website and we will be in touch with you to discuss your particular requirements.